afternoon, friends. Welcome to the Knowledge Setu session of JHS. A very warm welcome to each one of you to the webinar today on the new Income Tax Act 2025. Our endeavor is to make your lives simpler and better by explaining to you complex tax regulations, emerging areas of controversy around tax regulations, direct, indirect tax, and this is our first attempt on the new Income Tax Act 2025. This will be a series of webinars that we will bring to you on the Income Tax Act 2025 as it has transitioned from the old act to the new regime. The learning experiences from subject matter experts, from our clients, from our team members, etc. Today we have a very engaging discussion around the new Income Tax Act 2025. The discussions will be kicked off by our honorable guest speaker who will give us the keynote address today, Mr. Murtuza Kachwala. He doesn't need any introduction. He is a very well-known personality in the CF fraternity and in professional circles. Let me begin by introducing Mr. Kachwala to all of you. And then I will also introduce my senior colleagues on the panel, Kalpesh Parmar, Sharad Mehta, as well as Josefa Mala, who's going to make a presentation to you on the subject, followed by a very engaging panel discussion moderated by Deepika Bisawa, who's our lead partner on learning and development initiatives. She is a professional herself, a qualified company secretary. Let me begin by introducing Mr. Kachwala to all of you all. Mr. Kachwala is a seasoned senior finance professional with over 3 decades of experience, primarily in the areas of governance, risk, and compliance. He specializes in SOX compliances, risk-based internal audits, information technology reviews, carries deep expertise across several verticals. But if we were to pull out one sector that he is truly a subject matter expert on, it is the telecom sector, and perhaps the pioneer in the country in terms of deep diving reviews in the telecom industry, telecom sector. He is currently the managing director at Protiviti India, a member firm of Protiviti Global, where he leads global assignments across multiple geographies, working with cross-functional large teams, international clients. His experience spans telecommunications as well as sectors including manufacturing, pharmaceuticals, IT, services industries. He has played a stellar role at the Institute of Chartered Accountants of India, the Institute of Internal Auditors, where he has played leadership roles. He has provided strategic insight. He has served as the past chairman of the WRC of ICAI and continues to contribute to the professional growth of chartered accountants through thought leadership and as well as a lot of speaking engagements that we regularly see him on, especially on mentoring the younger fraternity of chartered accountants, helping them on seeking newer professional opportunities, including job opportunities, mentoring firms to elevate themselves to a larger vision by merging their practices and so forth. JHS is truly indebted to Mr. Kachwala. He has been a guide and a mentor to the young team of JHS. Murtuza bhai, a very warm welcome to you to this webinar and accepting our invite to be the keynote speaker today. I'll now continue my introductions. I have with me my colleague from Gujarat, Mr. Kalpesh Parmar, accomplished chartered accountant. He is a co-founding member of the JHS group. Kalpesh carries with him 27 years of solid experience around structuring, transactions, mergers, acquisitions, taxation, advisory, and strategic financial planning that also includes succession planning for family-owned businesses as well as for ultra high net worth individuals. He specializes in international taxation, exchange control regulations, and complex tax structuring across diverse industries. He's based out of Vadodara and he services clients across the country as well as in territories such as US, UK, Australia. He plays the role of senior partner and member of the governing council of JHS, where he leads the Gujarat region advising clients on acquisitions, transfer pricing, cross-border transactions. He also provides virtual CFO services and supports foreign companies in establishing and operating their businesses in India. Kalpesh is recognized for his expertise in dispute resolution, tax litigation, and liaising with regulators. He has successfully handled complex and unprecedented cases. He is known for his strong leadership, client relationship management, and ability to drive strategic outcomes while fostering a culture of excellence and innovation. Welcome, Kalpesh, on the panel, and we are looking forward to your expert insights. The next panel speaker I will introduce, again a co-founding member of Team JHS, is my colleague from Calcutta, Sharad Mohta, a seasoned and a senior chartered accountant with again 27 years of experience in audit, assurance, taxation, financial advisory. Uh, Sharad has contributed to the profession immensely. He regularly speaks at the Institute of Chartered Accountants of India, mentoring young tax practitioners as well as audit practitioners. He contributes extensively on the budget day and is also featured and highlighted as a sort of the speaker on India's budget day. He brings extensive expertise in accountancy, business strategic planning across diverse sectors. He's currently playing the strategic role of a senior partner mentor at JHS, where he plays and manages a large team operating out of Calcutta and the eastern part of the country, delivering comprehensive audits, tax solutions, dispute resolutions, and lot of financial matters and complex compliance matters. He is again recognized for his strong professional acumen, practical approach. He has built a reputation for delivering reliable and value-driven services. He is known for his commitment to excellence, attention to detail, and ability to support businesses through effective financial planning and advisory. Welcome, Sharad Bhai. A warm welcome and looking forward to your insights. And move on to the youngest colleague on the panel, uh, Josefa Mala, who's a very experienced chartered accountant with about a decade and a half experience, multifaceted personality. He's not only a practitioner but also an academician. He has been a faculty with leading colleges in the past, has done his articles under Mr. Nihar Jambusaria's firm, and carries with him a solid taxation experience revolving around income tax matters, transfer pricing, GST, the erstwhile VAT regime as well. Playing the role of a partner at JHS, he is manning and managing the Mazgaon office of JHS in Mumbai region. He's got a team of about 20 people under him who are advising clients on taxation, servicing outsourced accounting work of clients, and also managing operations. One of the large ticket clients that he's managing is a petroleum multinational company where they have operations across the country. His work spans domestic and international markets, including the US, UK, Canada, and GCC regions. He is recognized for his strong leadership, plan-centric approach, and has held key positions with ICI committees, founded the Baikala Study Circle. He is also a passionate educator, as I mentioned to you earlier, serving as lecturer at reputed colleges and mentoring aspiring professionals while contributing to the field of taxation and compliance. A very warm welcome to you as well, Josefa Mala, and we look forward to your presentation today. With this, I will hand over the stage to Deepika to take over the deliberations from here. Deepika, over to you.
Thank you, sir. So this session, I think Mr. Kachwala is facing some network issue, I believe. So should we start with Mala sir's presentation, sir? In the interest of time.
Absolutely.
Yeah.
Yes.
So over to you, Mala bhai.
Thank you so much, Josefa Bhai and Deepika for the warm welcome and for this opportunity. So I'll just present my screen. Is the screen visible? Hello?
Yeah, we can see it.
Okay. So welcoming everyone on this group for this income tax lecture. Now, we have already seen that 2025 Act, Income Tax Act 2025 is already there. And since 1st of April 2026, the new Income Tax Act 2025 has already come into force, and the previous Income Tax Act, old Income Tax Act 1961, has been repealed. So what are the key changes and how to do about the transition part? That is something what I would like to cover in the initial part of my discussion. So first question first, what was the need to repeal this act, to do away with the old act and to bring the new act? And what are the structural changes that has been done? And how do you read that act? That is first, let us try to understand. So I'm sure everyone is aware that in the old act, there were a lot of sections, lot of complications, and the way how it was drafted was very, very technical. And it was not very simple for everyone to just go through it. And because of that, what used to happen is that the comfort with the act was comparatively very less of anyone reading through it. So what this new act has tried to do is that it has come down to reduce the number of sections and do a lot of things in terms of its drafting. So now if we go a little bit in detail, first there were totally 819 sections. So when you say sections, so like you go by section 1, 2, 3, 4, that is good. But then along with that, you also had something like section 10, where there were multiple other different sections, then subsections. Then you have provisos, provisions, explanations. Along with sections, subsections, you also had clause, subclause, items, sub-items. That is how the act was drafted. And that was something about made the reading of the act very complicated for everyone. On an average, with all number of articles, students, and other colleagues, what I had seen, the comfort with the act to read the act, the bare act per se, was comparatively very less. So that was one very big difficulty what we used to always face. So now what we try to do is, first I would like to take you through the Income Tax Act, the bare act, where I'll try to compare the old provisions and how the new act has been drafted. Can you see the Income Tax Act, guys?
Yes, we can see it.
Okay. So the difficulty with the old act was what? That जब भी हम लोग ये एक्ट पढ़ने बैठते थे तो वो बहुत लेंथी था, बहुत डिफिकल्ट था पढ़ना. इस एक्ट को what the new act has tried to do is that it has made a comparative very simpler. So let us try to do a basic comparison of how the section and the drafting goes. पहले if we talk about a few sections, like you talk about section 80. Section 80 के अंदर there were a series of sections, right? So like 80, 80A, 80C, 80CCC, 80CCB, CCD, then CCH. Then you had got J series, R series, P series, a lot of them, right? Then you had subsections. So there were all lot of capital letters when you compared the sections. So now in this new act, what the government has tried to do is that in this whole act, there will be no capital letters along with the sections. So all sections one to one when you compare, it is either section 1, 2, 3, 4, 5, 6, and that is how the series goes. That is the first thing. Second thing was subsections, clause, subclause, items, and sub-items. That is something what still remains and has been retained. But along with that, there were also a lot of provisions, provisos, and explanations. Because of which what used to happen is that there used to be a lot of carve-outs. And with that, what used to happen is that the reading of the act and this interpretation used to become very, very difficult. So now what the government has tried to do with this new act is that all those provisos, explanations, they have been removed. So if you go through this new act, you will not find any proviso, any explanations per se, and all those provisos, explanations have been incorporated by way of either subsections, clause, subclause, items, sub-items that way. So that is how it goes. Then the number of chapters has comparatively been reduced. So first there were a lot of many number of chapters. Now the number of chapters has been reduced. And how the act goes now. So if you come to section number 1. So section number 1 is about the short title, extent and its commencement. The first act 1961, the older one, that used to say that it commences from 1st of April 1962. This act commences from 1st of April 2026. So therefore, this act applies from the year financial year 2026, 26, 27 onwards. So that is the first part. Going further, definitions as were there in the previous section 2 and now in the previous section 2 and now in the new section 2, they continue to remain. If you go through the clauses here, apparently the number of clauses what we had in the older act that were comparatively quite more. Now comparatively they have reduced the number of total clauses, and now total definitions have been reduced to total of 112. So also I would like to give you a glimpse here that in the initial old act there were definitions which were here forming part of the definition chapter itself, and there were also definitions which were forming part of individual subjects or individual chapters. So like you had definition of capital assets in the chapter capital assets. You have definition of capital gains, long-term capital gains, WDV in business and profession. So this way you had a lot of definitions which were subject related or chapter related. Now specific definitions still has been written there, but most of them they have tried to remove from there, from the specific chapters, and also they have tried to include here in this particular chapter. Also, the clauses we already discussed that here, since subsection and section are always something which always has an nexus. So the subsection always has to say something which relate to the section. One of the things what I have seen and I've observed with a lot of friends, colleagues, and students is that they usually refer this like subsection 1 of section 2 or subsection 2 of section 2. Here in this case, what I would like to specifically bring out is that these are not subsections, these are clauses. Because if a clause is independent by itself, it is a clause, and if it is linked to the section, the one which is above it, then it is basically a section and a subsection relationship. So here section 2 are all independent ones. So therefore these are all clauses of section 2 of the chapter definition. Now going further, we go to section 3. Section 3 is something what most of you probably would have heard. And Just give me a minute. Yeah, so section 3 talks something about the tax year. This is something what we have already heard of, that now the concept of previous year and the assessment year is no longer in present, and a new concept of tax year has come in. So what used to happen earlier is that a lot of times when we used to go to the department and we used to say that the case pertains to say year 24-25. So whether it was pertaining to financial year or previous year 24-25, or whether it was pertaining to assessment year 24-25. So the correct answer is that it used to pertain to assessment year 24-25. However, so many a times the clients specifically used to find it very difficult that what is the financial year, what is the assessment year, and why this kind of differentiation. So now, to make the life more simpler, and again to get it combined or get it aligned with a lot of other international jurisdictions, a concept of tax year has come in, where financial year 26-27 would also be called as the tax year 26-27, and the assessment or tax calculations or computations pertaining to it would also be done through this particular tax year itself. So now no more confusion between the previous year, assessment year, so on and so forth. Going forward, 26-27 onwards, we speak only for the tax year concept to make the life simple. Also, the provision says here that even if for one of the preceding years, say like assessment year 24-25, which technically means financial year 23-24, if I want to refer to that particular year, I can also refer to it as tax year 23-24. Hope this makes it simple. Then we go to chapter number 2, that is charge of income. So how the taxable income would be charged, mota almost remaining constant, except that the subsections changes a little bit. Scope of total income. So what is scope of total income? Usually ask somebody the scope of total income, they would say 5 heads of income, you get gross total income, less your deductions, you get total income, and that is how you get scope of total income. Am I right? But the answer is no. Scope of total income here means that what is the total scope of taxing some income under the heads of income tax. So what would be taxable, what would not be taxable is something what this scope calculates of. And the 5 heads of income and taxation thereof is technically what is we call it as the computation of total income. So you remember the provisions of earlier sections 9, where those deeming provisions of income received or deemed to be received in India, or accrued or arise in India, and what would be taxable in the hands of a resident may not be taxable in the hands of a non-resident. So that defines basically what the scope of total income is. Going further to section 6, that was a residency. So here again, the scope of residence mota remains the same, and what happens is only the sections, subsections, and the flow and the language what has been used in the act, that is something what is changing. Here, if you go through these provisions, these are comparatively very easily understandable and readable. So what happens is that you technically love to read this act, and the act is comparatively not that difficult as it used to be in the earlier 1961 act. So just on a comparative basis, section 6(1) of the previous act talked about your residency status of an individual. Those 182 days condition, 365 days in the previous 4 years, and 60 days condition. Then you had explanation 1 and explanation 2, where if a person is going abroad on an employment visa or going abroad a ship, those conditions were there. Section 2, subsection 2 related to HUF, subsection 3 related to status of a company, subsection 4, 5, 6, that way we had. Then we also had something which was introduced from Finance Act 2021, subsection 1A, which was basically a deeming fiction, which said that if you are a person who is earning foreign income and you are part of any country which is not within a jurisdiction which has taxation thereon, and if you have income more than 15 lakh rupees in a particular year, in that case those deeming provisions would apply and you would be taxed treating to be a resident and not ordinary resident. So provisions of 6.6 used to triggering. What has been done here again, if you compare the provisions, mota they remain the same, only the language has been made simpler and the subsections and the sections basically changes. So the first subsection 6.1 says that for the purpose of this act, residential status in India is a tax year of a person shall be determined as per the provisions of this section. So this is a generic one. An individual shall be resident in a tax year if he completes 182 days of condition and 60 days and 365 days of condition. That is 2 subsection 3. Now see this. It says about the earlier explanation 1 and subsection 4 speaks about the earlier explanation number 2 regarding a person who is citizen of India and who is going abroad for employment or who is going abroad for a job on a ship. So this is how the restructuring of the new act has been done. Going further, you come to subsection 7. Subsection 7 is nothing but your deeming provision. An individual shall be deemed to be resident in a tax year if he is a citizen of India, not liable to tax for a country in a domicile where there is tax residency and the income exceeds 15 lakh rupees during that particular tax year. So the word tax year has been introduced. The language which was very cumbersome and very difficult comparatively in the previous part, that has been reduced to comparatively very step-by-step, point-by-point process, so that the reading of the conditions given therein in that particular provision becomes comparatively more simpler. And then the things, the other provisions, so like subsection 2 has now become subsection 9, subsection 3 of the earlier act of relating to company now becomes subsection 10, so on and so forth. Subsection 6, which was there relating to not ordinary resident, now becomes subsection 13. So more or less, if you start reading this act, the comfort what you will get from this act is comparatively more, and it is much easier to interpret this particular act. So this is the benefit what would happen. Also, I'd like to take you further in terms of comparison of the old act in terms of the structural changes with regards to the new act. So one we said is that the number of sections has reduced. Subsection, clause, subclause, item, subitem, policy continues. All the capitals which were introduced over a multiple period of time through different various finance acts and all, those all have been done away with. Provisos, explanations have no further place. Also, I would like you understand what is called as non-obstant clause, right? So like we had a lot of sections which started like notwithstanding anything contained in this act. So they are all non-obstant clauses. So now there is nothing like non-obstant clause. What is now there is the language has been changed. The language has been made simpler, and the language what has been changed now is that instead of saying like notwithstanding the provisions of subsection 2 and subsection 6, now the provisions read as irrespective of the provisions of subsection 2 and subsection 6, so on and so forth. So the language becomes a little bit more of a slang and very comfortable, and not of that British English what was there, because the old act was comparatively like more of a copy paste policy from the British era, and all the laws were basically from that initial part. So this is another change. Another change what has been done in terms of structure is a lot of text has been removed away, due to which a lot of formulas what we had for a lot of calculations, like if we were to calculate like the earlier old act, like say depreciation or any other tax exemption in any one of the formulas. So there the all the formulas was explained through a drafted English language. Now what has happened is all those drafts has been done away with, and lot of formulas has been introduced. So that is another change. Also, a lot of tables has been introduced. So like if you talk about something like say depreciation or say something like TDS provisions. So under TDS also you had a lot of provisions like 194, so 194A, C, D, J, I, and a lot of sections relating to various things. So all those letters, I, J, and everything has been done away with. Now a lot of consolidation has been done, and a concept of table has been introduced. So table 1 is there, and instead of that those many sections, now you have item number 1, serial number 1, 2, 3, 4, 5, 6. So let me show you that also. So 393. So this is your TDS section, right? 393. So instead of those so many sections, now you have a table concept, and in table you have got the serial numbers. So now if going forward, if I were to say that I'm referring or what is the rate of TDS on commission on brokerage. So I would say that with respect to serial number 1 of table A of section 393, TDS provision on commission brokerage is as follows. Mota mota, what the government has done is to make our life simple, because it could have happened that all the sections and all the rates and everything could have been changed. But what would have happened is that because of that, the amount of difficulty what would have we would have faced in practice in again remembering and implementing everything would have been very large, because this is a very big and comparatively a very uh, large act. So what the government has done is that they have kept the Finance Act 2026 provisions constant, and considering those, this whole act has been drafted. So all the provisions which were there in financial year 2025-26 last year, assessment year 26-27, they have been principally been retained in this particular new act 2025. So all your threshold limits, your TDS rates, nothing changes here. Only the provisions or the way of how you read those, they change. So those 94C, J, I, they are all gone. And instead of that, you have got all these tables and those serial numbers. So now this is how you would be referring to in the act. Also, along with the sections, you have got a lot of, along with these tables, you have got notes beneath which you can refer, which forms part of the table itself. And a lot of other provisions they have removed, and what they have done is that they have introduced a concept of schedules. So like schedule 1. So first we had section 10 where a lot of exempt incomes were there. So now if you go to the schedules, the whole of section 10 provisions relating to exempt incomes and all, they have been shifted down to various schedules. So these are the schedules. So what conditions or what activities would constitute the business connection? Then you have got schedule 2, schedule 3, so on and so forth. So schedule T, all lot of section 10 provisions. 10.1 relating to agricultural income, that has been shifted to schedule 2 now, so on and so forth. So this is how the reading of the new act would be expected now. And along with this, I think this is something what we have already covered. The rules and forms also undergo changes. So what forms to apply, what forms to use from 1st April 2026 onwards, that is something what we'll see in our future discussions. So the intent of changing this act is something what we have discussed. Now going forward, what is the general philosophy of this transition and how the transition would happen is something what is more important. So now let us try to understand this. We are saying that from 1st of April 2026, the old act doesn't apply and that is no more applicable now. So a question that if I have to pay any TDS, how will I pay and under which act? If I have to pay my advance tax, if I have to pay my self-assessment tax, what would be the new process now? How would I pay my taxes now? If I have to file my returns for the last year, financial year 26-27, assessment year 26-27. So which forms to use and how would the process go about? That is something what becomes important and forming part of the transitional provisions. So what the Act says under section 536, 536 is basically a repeal and savings act. Repeal and savings act means that it repeals, means it does away with a lot of provisions of the old act. So the first subsection 1 says that the 1961 act has been repealed, means it no longer stands into existence. Subsection 2 gives out up to clause V, it gives out some 22 clauses, and under those 22 clauses it covers a lot of situations where how the transition to the new act would happen is something what it discusses. So let us try to understand. I'll try to walk you through all those important provisions to make you understand and to make it clear of how the transition would happen and how the filing of returns, how payment of taxes, your losses, everything would be taken care of. So general philosophy or the general transition FAQs. What I've tried to do is I've tried to capture a few important questions from the FAQ sections, and we'll try to answer them one by one so that all possible scenarios we try to cover therein. So the first question, does the Income Tax Act completely replace the Income Tax Act 1961? The answer is yes. Up to 31st March 2026, the old act existed, and from 1st of April 2026, only the new act 2025 shall remain and it comes into force. Is the income tax 2025 new taxes or does it increase the burden? So the answer to this is that no, the new income tax 2025 is not, though it is a new act, but it essentially carry forwards the provisions of the Finance Act 2026 and of the previous Act 1961, only with the modular changes what we discussed, structural changes what we discussed, and therefore there will be no change in the manner in which how you used to compute tax or how you used to pay taxes. Concept of AY and TY, assessment year and tax year, is something what we already discussed, section 3 of the new Act 2025. Will the existing administrative framework such as the PAN, TAN, faceless proceedings, etc. under the Income Tax Act continue? The answer is yes. What the government has done is that PAN, TAN of the existing PAN holders and the assessees of citizens, non-citizens would remain as it is. But for application of new PAN, TAN, they have come up with new provisions and new forms. So earlier we used to file Form 49A for individuals and 49AA for foreign citizens. Now what the government has done is that they've come out with new forms 93, 94, 95, 96. Under these forms, 93 is for individuals who are citizens. 95 is for citizens, individuals who are not citizens who are foreigners. So first, the 49A form was for companies and individuals who are citizens or residents of India, and 49AA was for NRIs and for foreign companies. Now they have come up with 4 different forms having 4 different categories, so that the confusion is comparatively lesser. And the for 93 form is for citizen who is an individual. 93 is for a person who is a non-citizen, a foreigner, but an individual. 94 is for foreign companies, and 94 is for Indian companies, and 96 is for foreign companies. So that is how the bifurcation has been done. For 10, again, they have changed the form. First, we used to file 49B. Now they've shifted to a new form, 135. So that is how the new forms basically comes in. The new forms comparatively should be more lucid and more of the online, and also there is a new facility which has been started, where if you have a Aadhaar, specifically the Indian citizens, you can have a e-pen where you can just put your Aadhaar and you can immediately have a electronic Aadhaar card, which you may not have a physical Aadhaar card available, but that electronic Aadhaar card will be something which will be immediately issued on the same spot, instead of waiting for a 7 to 30 days timeline, what usually we used to face. And the work becomes more faster, digitized, and simpler. Going forward, how does the Income Tax 2025 ensure continuity and smooth transition from the Income Tax Act 1961? This is something we already discussed. The 22 clauses of Section 536. Each clause defines a specific situation which will take care of every possible provision that may come to our mind, and how to go about those particular instances. That is something what we further discussed. Question 6. Are the old approvals, registrations, recognitions still valid under the new Income Tax Act? So what we are effectively saying is that if I had got some things like, say, a charitable institution, if it had got some charity certificate of 12A for, say, next 5 years, and only 1 year had elapsed and this new act comes in, so whether the new certificate will be valid for the additional 4 years, or whether we'll have to apply for the new certificate. So the answer is that that same thing remains valid enough, and the same certificate continues enough for even the existing act. Going further, how do we make payment of taxes, or how the collection of taxes would happen, and how the refund mechanism would go? So one of the very important provisions is regarding TDS. In the month of April itself, you would be required to pay taxes for the month of March. Now, March means you are effectively saying that you are still talking about financial year 25-26, meaning assessment year 26-27, which falls under the old act. Whereas when you deduct TDS for the month of April, you would be required to deduct TDS as per the provisions of the new act. So how do you pay those taxes? Which forms to use? Those are the important questions what we try to understand from this particular part. So first, does the fundamental obligation to discharge income tax through the TDS, TCS, advance tax, or self-assessment tax continue under the Income Tax Act 2025? The answer is yes. We saw section 293. So in the initial old act, we had section 195. Sorry, 192. 192 was pertaining to your salary section, TDS on salaries. Then you had 193, 194, and a series of sections under 194, and 195, which was relating to TDS on NRIs. Now what the changes has been done is that section 392 pertains to salary. That is one section. Under 393, which is one single section, under this section, all the other TDS provisions has been covered. So no need to remember 193, 194 series as such, and 195. Just one section 393, and that takes care of all other TDS provisions. Now in this we have got three tables of TDS which you need to refer. First table is regarding TDS on residents. So all provisions which pertain to TDS on residents, 194J, 194I, 194C, all those have been merged and they have been placed under table 1, which is pertaining to payment to residents. Table number 2 pertains to payment to non-residents. So the earlier section 195 has now been brought down to this particular table, table 2. So all possible payments to TDS on NRIs, they have been covered under this particular table. And table number 3 is the third part, where other than this situation has been considered, and that is how this structuring of 393 and the 3 tables has been made. Also, regarding TCS provisions now moves on to section number 394, the new section, where all the previous sections have been merged, and this one section takes care of the TCS provisions. So the TDS provisions continue to apply as it is, and for all transactions pertaining to the year ended 31st March 2026, you would continue to file and continue to pay taxes as per the old act itself using the old forms. So no changes as far as 31st March 26 is concerned. However, from April 2026 onwards, whatever TDS you deduct, you would be required to apply the new provisions referring the table of section 393 what we discussed, and you would be using the new payment mechanism and new filing of new returns, which will be applicable for the tax year 26-27 onwards. Hope this is making the point clear. Going further, what changes has been introduced in the Income Tax Act 2025 with respect to TDS provisions contained in the Income Tax Act? Which act will govern the TDS obligations during the transition period? This is something what we just discussed, that all the TDS deductions. Okay, one more thing. In case if you get confused that which provision to apply and in which scenario, the rule of TDS was very simple. In the earlier act and in the new act, the rule of TDS was very simple. What was the provision? That TDS applies at any time when the event or the payment occurs, whichever is earlier, correct? So if I provide for an expense, or if any income is received, or if the amount is paid on or before 31st March of 2026, so the old act would apply. So you would deduct TDS under the old provisions, and you would pay TDS as per the old provisions, old forms, using the old forms, and you would file the returns as per the old forms. But going forward, all transactions which the first event of either the accrual or the payment occurs only in the month of April 2026 onwards, then you would be using the new provisions of 2025 Act, new payment mechanism, new forms. Going to question number 3, which section should be quoted for TDS and TCS sections made available or after 1st of April 2026? Again, we have discussed this and the point remains clear. Anything after 1st April 2026, the new provisions of 2025 Act serial number table 393 applies, and if any event before 31st March 2026, the old act would apply. Now the fourth one says that how is TDS determined for contracts or services which are spanning over a period of March or April 2026? So this is again important, friends. If you come across any ongoing or a running contract where there is a live-in license, say if it is a rent agreement, and the rent is for 12 months. So what to do in case up to March and April onwards, or if it is any contract which is for April onwards, which a running contract, a construction contract maybe, for example. So all events, all activities up to 31st March, if the amount is being recorded, accrued, paid, anything up to 31st March, you have to presume that you are only under the old act and the provisions of the old act, payment mechanism, filing of returns would apply. And presuming as if nothing had changed, your contract would remain continued. No need to change the contracts. It remains as it is. and the provisions of the new act would apply for anything which is paid, received, recorded from April 2026 onwards. Going further, what is the due date for depositing the TDS to the government account, and whether there is any change regarding these timelines in the Income Tax Act 2025? The answer is the old provisions remains as it is. The timelines for payment of TDS was 7th of the next month, succeeding month, for April to February, and April in the month of March. That remains continued in the old act, in the new act itself. And is there any change in the rate of interest for delayed deposit of TDS or TCS under the new act? So the answer is again that the same provisions of the old act has been carried forward. Only the provisions sections have changed. So what will be effectively be required to do is that over a period of time, as we start using these new provisions, we would get used to these new provisions. So first, we were very comfortable with the old provisions. Now only that would change, but the provisions again in this remains constant. So first, if we forget to deduct TDS itself, we used to charge 1% interest on TDS, and if we deducted TDS but we fail to pay TDS, in that case we used to charge 1.5% TDS from the date of deduction to the date of payment. Same provisions, parallel provisions would apply even under the new act. Continuing further, how would the advance tax payment and self-assessment tax payment mechanism would work? So is there any threshold change in the advance tax? In the earlier 1961 Act, the payment for advance tax used to trigger when we cross a total tax liability of 10,000 rupees per annum. Same limit continues even under the new act. So there is no change. How will the advance tax be paid under the tax year system introduced under the Income Tax Act 2025? So new forms, new payment mechanism, a new portal, a new window has been made available. That is something what you would use. I would just like to log in into my account itself, and I would want to show you So see here friends, if you come to pay taxes here, now the portal gives you two options, whether you are making payment for 1961, the earlier act. So if the payments pertain to the old act, any payment for up to 31st of March 2026 or before, you would use this particular act 1961, and you will say continue, and you will make the payment under the old act. But if the payment relates to the tax year 2026-27 onwards, then payment of advance tax would happen through this particular window, and you would use only this window. So this is something that you will need to be cautious. Going back, if the advance tax for financial year 25-26 is short paid and interest is levied in the financial year 26-27 now, will the new act govern the interest provisions, or will the old act cover the interest provisions? So the answer is that the old act would continue, because 532 gives provisions, various clauses, what we discussed, and by virtue of those clauses, you would be required to pay your interest, short payment of taxes only for the financial year 25-26 onwards. Now, how about the asset tax, self-assessment tax for financial year 25-26, which returns you will be filing now? So year 31st March 26 is over, and you would be filing your returns July onwards, right? And there would be some self-assessment tax liability that would come in for the financial year 25-26, assessment year 26-27. So we discuss that you would pay only through the 1991 Act and not under the new Act. Going further, what precautions should the taxpayer take during the transition year while making the payment? That is just what we discussed. We went on the portal and we saw that you have to select the window properly. Otherwise, the wrong payment of tax would unnecessarily require you to make additional payment of tax because you may not be allowed to transfer those tax amounts. Going further, question 6. What happens to any MAT or AMT credits which were allowed to be carried forward under the old act but which are still not utilized on or before 1st April 26? So if you had any credits which were there in the old act, this Savings Act 530, the savings provision of section 536 clearly says that it allows you to carry forward the credits or any losses in a way as if the act had never changed, new act had never come into force, and the act continues. So if any loss or any credit you are allowed to say carry forward for a period of 2 years, 3 years, 10 years, 8 years, whatever the period be, you would be allowed to carry forward even under the new act, even with the revised forms, the way as if the act had never changed. Going further, if a person had an outstanding tax liability under the old act, is that tax still payable under the new act once it comes into force? So I was talking to a friend and on a lighter side he was telling me, कह रहे भाई वो पुराना एक्ट तो गया, अभी नए एक्ट के अंदर तो मेरे को टैक्स ही नहीं पे करना पड़ेगा, पुराने एक्ट का तो अभी गया तो उसका टैक्स हम लोग क्यों पे करेंगे, तो चलेगा क्या? So answer is clearly no. If there was any tax amount which was payable under the old act, that continues to remain be payable under even the new act also. And can the tax department recover old tax dues after the commencement of the Income Tax Act 2025? Answer is yes. As far as all assessment provisions, all recovery proceedings, all refunds, for all those administrative purposes, your old act would presume to have been in force in spite of the very fact that the new Act 2025 has come into force with effect from 1st of April 2026. So the department can recover then the outstanding dues or any payables along with interest penalty provisions as applicable in the new as applicable in the old act, irrespective of the provisions of the new act coming into force. And the third part, what happens to refund claims arising under the Income Tax Act that are pending on the commencement of the Income Tax Act 2025? So again, no need to worry here. All refund applications continue to say as it is. Even there is no requirement to file new refund applications or new applications as such. The old refund applications are in due course of time likely to be processed in the same way as if the act had never changed. Hope this brings clarity with regards to payment of tax, collections of outstanding taxes, and the refund processes. Going further, which income tax forms we will file once this new act has come into being? So now we are aware that from 1st of April 2026, new act is no more there. So what happens to the 31st March filing? I was speaking to one of my friends and we were discussing and he told me that अरे माला भाई अभी नया एक्ट आ गया तो अभी क्या करना पड़ेगा, अभी तो आपने फॉर्म का उन लोगों ने देखा इन लोगों ने क्या दिया, इसके अंदर तो बहुत सारा भी नया रिक्वायरमेंट आ गया, फॉर्म पूरा चेंज हो गया, पूरा सिस्टम चेंज करना पड़ेगा. एंड ही वाज वेरी वरीड कि अभी ये 31 मार्च 26 का जो फॉर्म फाइल करेंगे, न्यू एक्ट आ गया तो न्यू फॉर्म्स आ गया, तो हाउ डू यू प्रिपेयर, आपने क्या किया क्या नहीं किया, कैसे करेंगे? तो दैट इज द अमाउंट ऑफ टेंशन व्हाट वाज देयर इवन इन हिज हेड. लेट अस ट्राई टू अंडरस्टैंड व्हाट द प्रोसीजर ऑफ transition of this particular filing of tax process goes about. So first, will taxpayers be required to file 2 returns in this assessment year for 2026-27 assessment year returns? The answer is no. What the government has said, to make the life simple, for all 31st March 26 transactions, the old forms as such will remain. There will be no changes at all, and you continue filing of your forms or ITR 1, 2, 3, 4, 5, 6, whatever it was, your tax audit reports, your TP report, in the same form, same manner as we used to do last year. So no change absolutely for this particular year for filing of returns up to 31st March 2026. Only from the current tax year 26-27, forms would change as far as filing of ITRs is concerned and audit reports is concerned, which would be applicable in the tax year 27-28, and the forms will be notified at that particular point of time. So ideally, usually the forms for 25-26 always are notified by March-April period, right, of 26. Similarly, in the next year, new forms will be notified, and you will be using those new forms in the next tax year 27-28 for filing of returns of 26-27. Going further, under which act will the ITR of the income earned for financial year 25-26 will be filed? This is something we already covered and we have answered this. Now, section 115 BAC regarding to the new tax regime provides for new tax regime for individuals and HUF. Does the said new tax regime continue in the 2025 Act also? Answer is yes. All the provisions of the previous Act, only the provisions and the sections have changed. The provisions 99% continue to remain as such. So 115 BSC has been shifted to a new provision, and the provisions of new tax regime remains as such. If you had selected to remain in the new tax regime, which was there by as a default scheme, that scheme also continues as such, and you would continue to remain in the default scheme. Also, the old scheme would be applicable, where if you wanted or you had already opted for the new scheme and opted for the old scheme, you can always continue in the old scheme even under the new Act. Same likewise, even the presumptive taxation scheme, which was there under the 44 AD, ADA, AE provisions, that also continues to remain in force. Now only the provisions has changed. Now those sections has been cumulated under a new section, section 58, and there is a table given. And under the table, serial number 1, 2, 3, it covers situations of 44 AD, ADA, ADA, and AE by virtue of that provisions. So your life does not change as far as the immediate provisions, transition provisions in the month of April or this filing of tax return or the tax audit happens. You would continue under the old scheme itself, and the new schemes, the new forms would be applicable only once the new tax year comes in. Can the revised belated or updated returns for assessment year 25-26 or any of the earlier years filed on or after can be filed on or after 2026? The answer is yes. There has been no change in timelines. So you could file your belated return up to 31st of December of the same of the assessment year. You could revise your return up to the end of the assessment year. You could file your updated returns up to 4 years post your assessment year. Parallel provisions continue to remain in force under the new Act 2025 itself, and all those provisions would remain. As far as you are filing or you are updating any of the previous provisions or previous years, so you would be using only the previous old forms only for filing of the new returns for or applicable from tax year 26-27 onwards. You would be using the new forms. So anything to do with any forms for or on or before 31st March 2026, you would be using the old forms. Anything after 2026-27 tax year onwards, you would be using the old forms. So the old scheme, old mechanism of how you used to work absolutely continues to remain as it is. When will the new ITR forms will be available? This is something what we already said, that it will be notified by the government in the coming year. And if a taxpayer has incurred any loss in the financial year 26-27, can this loss be carried forward under the new Act? The answer is yes. This can be carried forward subject to the same provisions that the return is filed on time. Then the loss will be able to carry forward as per the same old provisions as it was earlier. Going further, very important, is there any change in PAN 10? This is something what we already discussed. What is the process for obtaining of lower TDS or nil TDS certificate? So the provisions pertaining to new TDS certificate, new low TDS or nil certificate has been now shifted to form a new form, form number 128, and the application again will be online. So first we have to do the hassles of going to the officer, going to the department. There would be ups and downs, and it was a comparatively cumbersome process. Now the government has intended to make this more of a faceless type, and within a subsequent limits, this would be granted to you on a online basis. For remittances made on or after 1st of April 2026, which forms and provisions will apply? So this is very important. All remittances in the course of international trade, specifically outside India, they were required to be made with respect to filing of forms 15CA and 15CA in the erstwhile system. So all payments made up to 31st March 2026 were made only after filing of form 15CA and CB. Now the government has come up with new forms, form 145 and 146, which are parallel to the old forms 15CA and CB. And filing these forms, you would be able to make the remittances in the same manner, in the same way is what you could do earlier. Which forms should be used filing of tax audit reports? So first, earlier we used to have form 3CA for corporate clients, 3CA, 3CB for non-corporate clients, and 3CD, which was the audit report. Now these three reports have been done away with, and a new form number 26 has been notified, or it will be notified, and only a single form for tax audit will be required to be filed per client, which would be more of condensed with various schedules pertaining to various deductions, TDS, losses carry forward, and all those reporting which used to happen in multiple clauses of that form 3CD. They'll be becoming more condensed and more systematic. That is what the rules say. Going further, is the provisional approval granted for a charitable trust under the Income Tax Act valid? This is something we already took up, that yes, the approvals granted in the under the old act would certainly continue under the new act also. Now, the new section, which is very important, very near to my heart, reassessment of incomes. So what happens to all those assessments which were already going on, or which were just concluded in this March 2026 time barring? So for which tax years will the reassessment provisions for the new act apply? So the answer for this remains constant, read with the relevant clause of section 536 of the new Income Tax Act of the Repeals and Savings Act, which says that all assessments pending ongoing up to 31st March 2026 will continue as it is, and they would be concluded as if there had been no introduction of new Income Tax Act 2025, and only new assessment would happen. Only the new assessments as per the new act would happen only for the tax year 26-27 onwards. So the new act applies for assessment pertaining provisions only for the new act tax year 26-27. The old act provisions forms the process of the erstwhile section 148, 148A notices continue to remain as it is. Okay, going forward. I'm little short of time, so I will have to go a little bit more faster. After 1/4/26, can the Income Tax Department initiate fresh assessment proceedings for any earlier assessment years under the old act? The answer to this is again yes, because the assessment year pertains to the old act as per the time limitations of section 149, 149, 150, and 151. The provisions of opening of the assessments, the timelines, and the approval authority. As far as the department is adhering to those provisions, with respect to those, the assessment of any of the earlier years can be opened, and it can be started. Can the assessing officer simultaneously conduct assessment for assessment year 24-25 and even for tax year 26-27 for the same assessee? The answer is yes, because both are independent acts, both are independent years, both are independent provisions. So if a assessee has done any non-compliance or any escapement of tax with regards to any of the earlier years which was part of the earlier act, the old act, the provisions can be started under the old act, and if it is under the new act, the answer is parallelly it can be done under the both the acts conclusively. Which act will govern the penalty provisions relating to the tax years beginning before 1st of April 2026? So again, as per the old provisions, if the tax assessment is completed as per the old act, the tax liability, the interest and penalty will be applied only as per the provisions of the old act, not as per the provisions of the new act. The new act would apply only from tax year 26-27 onwards. And what are the time limits for issuing assessment notices under the Income Tax Act 25-26? Has they undergone any changes? The answer is no, they have not undergone any changes. So timelines remain the same. So if notice could be issued to you within a period of 2 years, the same provisions applies and it can be issued to you in a period of 2 years. So 3 years, 5 years as per the act. So I've done a comparison of the old sections and the new sections and the timelines, but due to paucity of time, I'm not going into this timelines as of now, and I would like to take the other important provisions continuing. TDS compliance we have already covered. So what is the fundamental rule for determining which act governs the TDS obligations? This is what we have already covered, that up to 31st March 2026, the old provisions would apply. For April 2026, the new provisions and the new sections would apply. Just let me browse to this a little further. One very important thing is question number 5. Are tax deductors, are we required to modify our ERP or the accounting system and the payroll system after commencement of this new act, that is from April 2026 onwards? The answer is yes. Why? Because up to 31st March 2026, the provisions under which your accounting system was capturing the TDS was as per the old act 194A, B, C, J series, right? But under the new act, your serial number, table number, and 393 would apply. So from April onwards, whatever TDS you would deduct now for the tax year 26-27, your system should be capable enough of capturing those information. Hence, you would have to ensure that your organization is modified and has been updated to capture the correct provisions for April 26 onwards. And will the ETDS and TCS RPU support the both old and the new formats? The answer is yes. Both the formats would be available on the portal, and you would have to have proper caution and file the returns accordingly as per the time periods. Going forward, what about set off and carry forward of losses? Has the fundamental principle of set off and carry forward of losses changed under the Income Tax Act 2025? The answer is no, it has not changed. So we discussed this, that as per clause M and clause N of section 536 of the Income Tax Act 2025, if the assessee was allowed to carry forward his losses for a period of 8 years, subject to the conditions of the old act. If he fulfills the conditions of the old act, he'll be able to carry forward the conditions of the new act. So if the conditions of the old act under which he was allowed to carry forward the losses, if are breached, then under the new act also he will not be allowed to carry forward his losses. Otherwise, he'll be able to carry forward his losses even under the new act. And can losses computed under the Income Tax Act 1961 be carried forward under the Income Tax Act 2025? The answer we already discussed is yes. You'd file your returns on time. You would file under the old forms as of March 2026 audits or the ITR filing is concerned. And going forward, tax year 26-27, you would be filing the new tax forms, which should be auto capturing the details from the containing series of forms, and the same would be allowed to be carried forward in the similar manner as if the act had never changed. The last part very important part again is issues concerning the NRIs. So a glimpse of it we've already seen. Whenever we talk about NRIs, the first thing that comes into our mind is Section 6, because until you do a residential test of whether a person, an individual or a company is resident or non-resident of India, till that time the taxation system doesn't work. So we already did a quick review of the new act, where we saw that the provisions has changed in terms of the mannerism in which the drafting of the subsection has changed. So subsection 1, which said which first discussed about the individual test, that has now been shifted to subsection 2. Subsection 3, 4 takes care of the explanation 1, explanation 2 of the act. The non-resident provision has become now the section 6. Old act now becomes section 13. That deeming provisions becomes 6, 7. So this way the provisions has changed for sure, but the provisions per se does not change. So the basic test of residency, answering question number 1 with regards to individual and question number 2 with regards to company, does not change. So if a company is a domestic company, or if the POEM, place of effective management, is in India, then the company would be resident of India. Then how does the deemed residency interplay with the repeal clause? So you remember we did this with regards to section 6(1)(a), where if any individual who is a citizen of India and he is a resident of a jurisdiction which is basically a non-tax jurisdiction, non-tax jurisdiction, and his Indian income exceeds 15 lakh rupees other than his foreign income, so he would be deemed to be a resident and ordinary resident of India, earlier by virtue of section 6(1) and now by virtue of section 6(13). So with this, sorry, 6(7), and with this, the provisions are same. Only the act, the act or the relevant provision has changed, but they continue to remain parallel. Now, whether the provisions relating to concessional tax regime for NRIs as contained in the earlier section 115D, 115E, 115F of the Income Tax 1961 has they undergone any changes under the Income Tax 2025? So you would recollect that under 115D, this was specific provisions or specific scheme of taxation for non-residents available, where any deductions of chapter 6A were denied in this particular section. 115E was a section where any income from any investment, specified investments, was charged at a flat tax rate of 20%, and any capital gains, 115F, was being charged to tax at the rate of flat 10% or 12.5% depending on the category of or the class of specified asset. Those similar provisions has now been shifted to section 123, 124 and 125 parallel provisions, and the provisions has been written as such. So there is no change. So for NRI clients, those scheme of specific taxation continues to remain as such. Also, has the return filing exemption for NRIs under section 115G of the Income Tax Act has continued. So friends, you recollect that if a NRI has had any income on which TDS was sufficiently deducted, he was given an exemption under this particular section from filing of his return of income. Similar section 126, a new provision has been inserted, which gives a parallel exemption for filing his income tax return even under the new Act 2025. And the last part of the day, that the NRE interest used to be exempt from tax in the erstwhile provisions. Now this we saw that a lot of provisions regarding specifically to the what do you call it as the exempt incomes have been shifted from specific clauses to now the schedules. So now this has been shifted from this provisions part, the section part under the new act, to a new schedule, and where the exemption has been given. So the provisions of the NRIs mota continues to remain as it is under the old act. So thank you with this.
Thank you. Thank you, Mr. Mala, for the very insightful and detailed presentation. This really helps us understand the practical foundation of the new act. Let's go ahead with the panel discussion. So for the panel, we have today our very senior leaders, Mr. Sharad Mohta and Mr. Kalpesh Parmar. So thank you. Thank you both for joining us today. And can we have you on the cameras, please?
Yeah, I'm there.
Okay, great. Great to see you, sir. So, my first question, as Mr. Mala has already covered a lot of points, but there were a few points which I was noting down, which are still pending to be discussed. So, my first question is, the income tax department has completely renumbered all the, sorry, how does the income tax 2025 change the taxation for shares, buybacks, and what does this mean for promoters and investor? So, anyone would like to take this question?
Sharad ji, aap? Yeah, I can take it. That's not an issue.
ले लो कल्पेश भाई ले लो no problem.
Okay. So
आप ले लो, आप ले
the
लो.
buyback of shares as such has been already been amended in the old act itself, but that amendment has been taken over even in this new act. So basically, the amendment is being done that in the buyback shares earlier it was that the tax was paid by the company and it used to be exemption in the hands of the taxpayers. Now this thing has been changed to, earlier it has been changed even in 1961 act, that it will become a dividend sort of income in the hands of the taxpayer. Now the further amendment has been done except for all non-promoters, that it will be taxed as a capital gains, which it should have been done even in 1961 act. So in 25 it has been now been decided that it will be a capital gains in the if the person is a non-promoter. In case of promoter, it will still hold in, as a other sources income or a dividend income. So this is the major change so far as buyback of shares has been concerned.
Okay. That's this is actually
The
this
tax
seems to
rate
be
also
made.
differentiates.
Uh-huh.
The tax rate also differentiates. When
Okay.
in case of a buyback, the promoters will have to pay at 30%, and the promoting companies will have to pay about at the rate 22% plus surcharge and cess. So the tax rate also differentiates now.
Okay. Okay. This is I'm sure this is getting really interesting and very informative for our audience. Moving on to the next question. What changes have been made to the MAT, the minimum alternate tax? So as per the new act coming in, so are there any changes in this or so maybe Sharad sir, would you like to take this question?
Yes. MAT, the provisions of MAT have gone under a bit of a change. Was in the old regime, the MAT credit was available. In the new regime, the MAT credit is not available, and that is continued in the new act also. That is the major change.
Okay. Kalpesh sir, would you like to add anything here?
No, I think what he has covered is it's fine because that's the only thing which was living still in the MAT. So credit is not going to be available in the new regime taxation.
Anymore.
And the
Oh,
MAT tax
okay.
has gone down by 1%. The tax rate has gone down by 1%. I think from it was earlier 15, now it's 14.
Correct.
I'm so sorry, somebody was calling me. Moving on to the next question. Investors claiming interest deductions against the dividend income will face a significant change. What is the change and how does this affect investment planning?
So I would like to take it. So earlier, what
Yeah.
happened that
Yes.
HNIs used to do the portfolio investments in the mutual funds and other funds, and where they used to get the dividend income, as well as they used to plan certain borrowings against such investments. So these there was an interest deduction available and as other sources income against the dividend. Now that has been discontinued. Even it was last year amended. So that amendment continues and it will have that effect clearly to the most of the people who are planning for having a interest deduction against the dividend income. So now that deduction is no more available.
Okay.
So basically, earlier, which the investors used to get a deduction of interest from their profits on sale of investments. Will we are not, they are not, they will not get that. They are denied of that profit and they have to pay tax on the entire profit.
So more so that was a planning implication, I would put it like that.
Yes. Yes.
Okay. Now let's change the gear. Let's move on to the crypto side. So what is happening on the crypto? So crypto digital assets have been always a gray area under the tax. So is this bringing that under taxation in the new regime? Is that or anything related to the virtual assets which we have?
KP.
Yeah, sure. So now they have recognized the crypto and digital assets, and the taxation is also been recognized over here in this act. Moreover, you need to make the disclosures. There will be a schedule in the form which will be required that crypto assets or cryptocurrency investments has to be disclosed in the return. And they, in fact, there is a penalty if there is a missing in disclosure even. So that penalty is almost 60% of the value, which has to be, if at all you are not disclosing the return. So I think the acceptability which was missing in earlier act is now clearly taken up in this act. Going forward, that crypto and digital assets will be a asset which will be shown, and the taxation is already been defined as a 30% taxation on that.
So there is
So,
no
Deepika.
setup of crypto loss with any other income. That
Yes.
continues.
And I
That
would
can
also like to
continue.
add one more point over here, that not just crypto requires a specific reporting in the forms for sure, but a lot of clients usually fail to report foreign assets or any foreign bank accounts, or even when they have got any signing authority in any foreign bank accounts. That is something very important. So of late, a lot of notices has been issued by the department to a lot of clients. Specifically, you might be aware that before this war, the Dubai was very aggressive in marketing the properties in Dubai and all across India, and a lot of clients had invested in Dubai or started companies there and wanting to do some business via the Dubai route or via the UAE route or via the Middle East route. However, if you fail to report those transactions specifically, which requires specific reporting, there are very significant penalty provisions which were there in the old act and which continues in the new act also. Thank you.
Okay. Very well explained. Very well explained. Now, many of our audience are either employer or employees. So let's have one question for them as well. So many salary employees in growing cities were not getting benefit of 50% HRA exemption. What has changed in this 2025 Act? Maybe Mada, Bhai, would you like to take this question?
So more number of cities, I believe, have been added to the list of eligible cities, and the percentages have been nominally changed. So based on that, the amount of HRA exemption, if planned properly, that is somewhere the employees may be able to have more benefit in terms of tax savings, and possibly structuring needs to be seen. And if planned properly, certainly there will be more benefits that can be done.
Okay. Okay.
So I think the 4 cities are added. Apart from the 4 metro cities, the 4 cities are added: Bangalore, Ahmedabad, Hyderabad, and Chennai, and I think Pune are being added.
Pune.
Okay. So, in the interest of time, I would like to take if there are any audio question from the audience. Let's see if they have posted anything in the chat box.
So there, Deepika, can I take? I think there are a couple of questions already posted in the chat box.
Yes,
So
yes.
there is one question relating to income tax year. So basically,
Mhm.
this act do recognize the income tax financial as a financial year or income tax year from 26-27 onwards. So far as income tax year 25-26 is concerned, it will be considered as assessment year 26-27. And also 26-27 will be a tax year for the from the financial year starting from April 26. So the last financial year, that is under the old Act 25-26, will be considered as an assessment year for the 26 as a 26-27 year. And I think there was a very interesting question in the chat box, that what is the difference of uh, irrespective and notwithstanding. That's a technical word which I think Mala has also highlighted. My say on this is that notwithstanding has always been overriding effect, or sort of a just getting out that this section has overriding effect to all other sections or all other provisions. So it was like that. Now bringing in irrespective provides that what is the scope of the present section. So it does not affect the other sections, but if we have to read these sections within the framework of the section or the provision provided in this specific section. It does not go and say this, I override all other sections. It just says what I am stating is wherever stated or not stated, this will be considered to be stated within this. So I think the irrespective word, adding by putting irrespective word, has been given more clarity for the reading of the act is concerned. And I think it's giving a better clarity. Scope is limited. It is not like that scope is so much enlarged that it overrides everything. So now by bringing irrespective, I think the scope has been made limited to the section which provides that irrespective wording, and not
It is
to
it is
affecting other sections. Yeah.
it's a better English which can be understood by normal people also.
Yeah. The drafting is simplified. Earlier, the language was
Yes.
little
So just
Yes.
to make it more
tough.
simple, just to make it more simple, so like normally whenever if I had to call you early, what I would have typed on my mobile is come ASAP. So ASAP is nothing but the new English of the world, right?
Yeah.
So what the government has tried to do
So
is
the
that
earlier act,
not go
the
down to that level maybe,
earlier act was
but
having a
to find
better bread
something
and
in
butter for
between,
us than this new act.
something in between, yeah.
Okay. We have just received one question. Sir, what is the effective date for Form 144 for TDS of NRI, seller of immovable property?
So I
We
think
just
for
received.
me, if I have correctly read, then it will be from October 26 onwards. So till that, it will continue to govern by the old act form. So like the corresponding 26 QB thing for NRIs will be effective from October 26. That's what if I recollect what I've read.
Okay. Hope
First
that
October
answers Samrat's
2026.
question. And we have received one more question. If we have paid excess tax in the old act as on 31st March 26, can we adjust this excess paid tax amount in the next year?
I
The
think
previous year.
most of the taxes will be paid for the particular
There is
year.
nothing, there is no
And if there is
clarity
a
on this.
liability of that year, it will get adjusted. If there is no liability, you will get that refund of that tax. But it is not like that you can
Yes.
adjust the tax of assessment year 26-27 with finance now tax year 26-27. That will not happen.
Okay. So with that, I think, sir, the income tax 25-26 is called as a tax year 25-26 now. This question is from the audience. I believe this question was already asked, addressed during the session. So no more audience question. So
I would
with
just
that,
like to put sorry Deepika, I would just like to put one more thing over here. Maybe Somewhere I could not find in Mala's presentation that point was covered or not. But although the act has also been amended in 1961, but in 25, that is one thing. There is always a problem that we can't revise our return post December. Now there is a 3 months window to revise this return, of course with penalty, with
Okay.
means some penalty is being charged, but still you will get a 3 months more window to revise your tax return. So now it is enlarged from December till March. But
Nice.
unfortunately, things what happen, even if your tax deadline gets extended, this revised return deadline does not get extended automatically.
Okay. Okay.
So that's
Well,
all from my side.
okay. Well noted, sir. Thank you for the addition.
Deepika,
With
before we
that,
close, can I
yeah,
have one query?
yes, please.
My query is, after introduction of this Income Tax Act 2025, are the amount of assessment, litigations, and the tax notices going to go down or not?
It should. I
Because
would put it should, because of the clarity and the complexity, removal of complexity of various provisions and other things. I think ideally it should go down, because lot of litigation or the case laws which has been come up over a year has been considered in this act, and thereby it has to go down. That's my take.
so that is what Kashmir Bhai has to say. Sharad Bhai, yeah, you are saying something.
I have one question for everybody. Uh, when you are filing an appeal, in the old act, the percentage to be deposited was 20%. Subsequently, now it is 10%. So if an appeal pertains to the 1961 Act now, and I'm filing it now, so how much percentage of tax needs to be deposited, whether it is 20 or 10 in tax year 20? I'm filing it in tax year 26-27. Anybody who can answer this?
Yeah, I can. My point is that if it is relevant to assessment, whatever assessment year before the tax year 26-27, that will go as the old provisions only, irrespective of the when you are filing the appeal. But only point is that in
Correct.
that law also, there was no condition required to pay any tax while filing the appeal. Only thing, you can get a straight stay of demand if you pay 20% in first appeal. So that provision
Correct.
were working in that form. So I still feel that it will go with that way only.
Okay.
So Deepika,
Thank you.
that was a
Yeah.
little bit change of topic by Sharad Bhai. But again,
Mhm.
going back to my earliest question, that what would
Mhm.
happen to the number of assessments, scrutinies, reassessments, whatever that happened. So Kalpesh Bhai said his point of view. My point of view is something what I'm trying to stay neutral. Uh, Kalpesh Bhai point of view is very positive and optimistic. Maybe I'm still not that much optimistic. Reason being, by changing of language, are you able to change the mindset of the people who are given the task of making those assessments or putting it to task? So if that mental set doesn't change by change of language, because 99% of the language what they've tried to do is the provisions they have tried to keep it as it is, but the language has been changed to make it more simpler. So by change of a particular section to a table or to a schedule or to some another subsection, whether it will actually bring down the amount of litigations is something what only time will show.
Yes,
No,
exactly,
so Mala,
Malawai.
sorry, Sharadji, Mala, I
Ah,
would still like to justify my answer by stating that there is one provision. I don't remember the actual section of New Act 25, but there is now provision that even the CBDT circulars or instruction will be binding on
yes,
department. Although it was
yes,
not there
yes.
in the Act earlier, now
Right.
the Act provides that
Now,
this will be binding. So automatically the litigation relating to such frivolous litigations used to happen in the earlier provisions or earlier regime, it will has to go, because now the act itself says that these are all binding on the department, even if it is not binding on the SSC, but it are definitely binding on department, which they were just ignoring those provisions or those circulars or even those instructions. So that is the one of the reason I am still optimistic that the litigation has to go down.
The
Keeping finger
interpretation will become simpler. When the language is complex, the
C-
interpretation varies. Yeah.
And
And if the
CBDT is
language
going to bring out such circulars to make it more simplified and more litigation free things.
That is
That
what
will
the
be
The whole
objective
idea,
is,
the
and
whole idea is
certainly
yes.
that is
The
what we
objective is that.
would look at.
okay. With
So
that
now
note,
you need to change your answer that you also agree with me.
Still, I am. Time will show. I was very clear.
I
yeah,
am with
exactly.
Mala in saying that let us give this act 2-3 years,
We'll
then
have
only
to.
we'll
We'll
be
have
able
to.
to
We'll have to.
understand how less the litigation is.
Also, how the old judgments are taken up with regards to the new provisions. Provisions remaining the same. Litigation always used to happen in the earlier act. And if same thing continues just by changing the language, do you actually change the mind shift? That is the biggest question to my mind. And that is something what only time will show. So possibly this is the first lecture on tax series what we are doing today. But looking forward at many such more sessions. And with time, as new and new provisions or new and new litigations or experiences start coming in, probably we'll come up with a new series where we'll keep on adding up on more of such information and knowledge along with the teammates.
So
Definitely.
sorry. Yeah. So there is one more follow-up question. If the SSC does not agree to CBDT circular, which is binding on department, it will also open for litigation. I fully agree with that. But unfortunately,
Yes,
what was happening, that department, by not following the CBDT circulars and instruction, they were creating all the litigations. Unfortunately, that CBDT instructions, only if it is so much adversely affecting the SSC, then only the SSC were not following. Otherwise, SSC were clearly following all these instructions and CBDT circular. Only thing was happening that department was not following. That is the reason I am
that
still
loophole
feel
has been
that
plugged.
once department has been now mandated to follow these things by the act, the litigation has to go down.
Right.
Thank you. Thank you for the. With that note, let's conclude the session today. Frankly speaking, the insights were really very it was truly insightful discussion, very practical and extremely relevant to all of us. Clearly, while the intent of the lawmaker is to simplify the law, but everything depends on how it is implemented practically. So, like Mala Bhai said, that how it will certain percentage will definitely depend on the person's mindset, and certain percentage will definitely improve because the language is simpler. So let's wait and watch what happens in the next phase. Till then, thank you so much everyone for joining in. Thank you so much for all the speaker for this wonderful contribution to our knowledge, and thank you. We will continue to do such
Thank you
series,
all.
and till then, have a nice day. Have a nice time.
Thank you.
Bye-bye.
Thank you.
Thank you
Thank
so
you.
much.
Thank
you.
you
Bye-bye.
all. And a big thanks to Mala for preparing such a nice presentation.
Thank you so much.
Big
Sir.
thanks to
It
Thank
was
Mala.
you.
very detailed. Yes.
Thank you. Thank you. Thank you.
Very nice. Thank you. Thank you, everyone. Bye bye. Have a good day.